Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. In this clip, we're going to look at ratios, a whole bunch of different ratios, see what's changing against an asset versus an asset. So ratio is just an asset versus an asset compared to history. And you can look at a whole bunch of different assets compared to each other, looking at history. And then what you do is you pick out the cheapest assets and invest in those groups. The whole key to investing, this is literally the entire key to investing, is to find the cheap assets, buy the cheap assets, and then figure out what the market conditions are where those assets go from cheap to expensive. And that's really the thesis of the entire channel. When I went back and I looked at how to make money, I just asked the basic question: how does one make money in the markets? Well, you're going to have to buy something that is out of favor, that becomes back into favor, and that money rotates from wherever into that sector. So I did a bunch of research, looking at charts, looking at ratios, looking at all these different things. And what I think is the best way to make money is to buy undervalued assets. And the way to do that, the way to identify undervalued assets is through ratios. Then I looked at the market conditions. And what I have found is that real estate impacts inflation. If real estate impacts inflation, inflation impacts interest rates. So the driver really is demographics. So when you have demographics that balloon up, shrink, but balloon up again, that's what changes the interest rate. And we want the demographic to move all over the place, because that's what gives you the opportunities to buy certain assets at certain times, which do very well under certain market conditions. Expansionary phases are inflationary. They usually have increasing interest rates, which means home prices go up with interest rates, because interest rates chase the inflation. Not the other way around. Home prices don't go up from a declining interest rate environment. That's when you have crashes. The demand for loans goes down in a crash, not up. So I've got some ratios. They're behind me. They're not all ratios, but a lot of them are. I'll try to explain them as I go through them, and I'll let you know what's expensive and what's cheap in comparison to history. This is where you make your money. This is where you should be looking, and your main importance should be here, because this is what value is. If you chase value, you will make money. If you chase price, that's what new investors do, and they usually get slaughtered. So you want to chase value, the price will come behind it, so long that the market conditions are ripe for that revaluation to occur. So here we go. Let's jump in here. I just started with the CRB Index just to get the blood flowing. We've got a nice bearish or bullish engulfing, which means we're probably going to continue to head higher in the CRB Index. This thing's on a very strong uptrend above its 50-day moving average. This is the 200-day in the red, 50-day in the blue. We've hit the 50-day a few times, and it just keeps going. Looks absolutely fantastic. We've got a long-term perspective on the commodity to stock ratio. We are in everything except commodities bubble, where commodities are dirt cheap. This is where the opportunities are. Wherever you're in the green circle, you want to buy commodities. That's exactly where we are. You want to sell them up top. Your sell signal comes from the ratio. It comes from money flowing out of stocks and into commodities, and this ratio changing over time. That is what gives us a buy or sell signal. It means money is not in commodities at the moment. It's flowing into it. That's why we're seeing the ratio change. And that's where we want to be. The market conditions are right for this revaluation to occur. Here is the CRB to S&P 500 real time. We were coming out of this huge bottom. We developed this pattern. We broke to the upside, came back to do a back test, retest, and now we're heading up to the upside again. Perfect time to be looking at commodities right now. Not a year from now, not 6 months from now, right now. Whole bunch of different sectors that we'll look at. This is gold in relationship to oil. This is going back all the way to 1861. Hopefully you got enough data here. Notice that this ratio, whenever you get above 30, isn't screaming buy. Well, what is this thing? On the right-hand side going up to 90, that's called the anomaly of the event, where they shut down the economy. That was an opportunity. That is where you could have bought oil shares for as close to free as you possibly could. And if you were shopping around for oil, this is what you would have heard and should have heard when looking at this ratio. Aisle 4 is free. Oil is free. See, did you hear that? Oil's free. And you should have been in there looking at oil companies in 2020 if you had known this information. Here's the gold to oil ratio real time. It's compressing downward, which means that oil is outperforming gold. Whenever you're going down, the denominator is outperforming. We're coming on down and we're just cycling down and down and down. I think that over the next bull market, oil is going to continue to outperform gold for the commodity bull market. And if you look, you can see this thing goes from 30 and compresses down to about 10 or below. I think we're going from 90 down to below 10, a 10x on the ratio, not even on the price, on the ratio. Remember, gold's a moving target. Gold can move higher. Oil is going to move higher faster. We're in an inflationary, well, let me go back here. This is signaling an inflationary environment. When we're compressing this, it's inflationary environments with increasing interest rates almost every time. 1910s. From 40s all the way down to 80. From 2000, we compressed it all the way down to late 2000s. And we're going to compress this all the way down below 10. In an inflationary, increasing interest rate environment is my guess. Why do I say increasing interest rates? Because in history, every single time we've seen that. Not just once, twice, every single time we get these types of conditions. Here's the platinum to gold ratio, looking at it from 1971 when it was more freely traded. I think it was a little bit after that, but the ratio was up around 2 and greater during some of these periods of time. We are at 0.5 right now. I'm going to show you real time, 0.59, 0.6. We got all the way down to 0.52. Guys, this is ridiculous. We're off the charts in terms of historical data. Platinum is so cheap in relationship to gold that you should be looking at it. We've got a little downtrend break too, which means that platinum's going to start to outperform gold, I think, here any second. Here's the platinum to silver ratio. Looking at history, the cheapest it's ever been was 1980. That's the most overpriced silver has been to platinum was 1980. Looking at other periods of time, around 40 is incredibly expensive for silver in relationship to platinum. Platinum, when it's expensive, can buy 140 ounces of silver. 120 ounces, 140 ounces. That's ridiculous. What are we at today? We're at 43. 43 is on the cheap side. Super cheap. Signaling platinum is a screaming buy. If you use the platinum to silver ratio. You think silver's cheap? Well, platinum's in the dirt. It's dirt cheap. Platinum to palladium ratio. We're at something like 0.5. We are off the chart for platinum being cheap in this platinum to palladium ratio. You know what's funny? Platinum can substitute palladium. There's no reason for it to be this cheap down here. Usually platinum's more like 3 or 4 times the price of palladium. Huge opportunity here. Here's the real ratio, real time, 0.53, and it's coming on up. The substitutions will happen. What about real estate to gold ratio? You know what's weird? Real estate's cheap in relationship to gold on a historical basis. Is real estate expensive? Your answer should be no, not in relationship to gold. And if gold is cheap to the monetary base, real estate is cheap in relationship to the monetary base. I know that sounds funky, but it's true. Looking at the copper to gold ratio, breaking out since the mid-2000s to the upside for copper to gold ratio. Copper should outperform gold. This also extends all the way back up here into the 1970s. It's a huge chart pattern. And we just broke it recently where copper could do some outperforming. Massive outperformance. What about the monthly gold to SPX ratio? So this is gold to stocks. We're down here no man's land almost. I mean, it is incredibly cheap. This is going to break the downtrend, which we did, and it's going to come and get revalued all the way back higher again. Give it some time, but gold's cheap to stocks. Stocks are expensive to everything. Outside of maybe, I don't know, cryptocurrencies, but gold to monetary base. What does this mean? Gold is cheap. Super cheap. It's never been this cheap in relationship to the monetary base. This is the 1970s where it revalued itself. Higher inflationary environment with increasing interest rates. Are we going to have that same type of environment? I think so. I think we're going to have increasing interest rates and an increasing inflationary environment. We can see the inflation. It's right in front of us. We have an expansion phase of real estate with a larger demographic of the millennials. It's a great time to get revalued. And if you're going to get revalued, you might as well look at some gold. Now, what about, I did the XAU to SP 500 ratio. 0.03, man, we're getting close to nothing. All the way down from 2011 down to 2016. 2016 is when the housing market firmed up. That's where we ran out of foreclosures. It started firming up. We're getting a little bit more inflation. Now we're in an expansion phase. It's ready to go. Let's break back up here. If this were to occur, you're going to get massive purchasing power gains through your gold and silver mining companies against the S&P 500. And it is incredibly low and cheap right now. That's a spot I would be looking at and loading up. Here's platinum to S&P 500. We're looking at some of these to those stocks. It's way down here. Platinum's going to come back up eventually and do some revaluation against stocks. Here's the stock to oil ratio. Oil's been outperforming stocks. It's coming back down, but it's still in an uptrend, meaning that the S&P 500 stocks are still outperforming oil. And that makes sense in any type of normal market environment, but in a highly inflationary environment, I think oil is going to do very well. So those are the ratios that I went over, just to get you guys kind of accustomed to some of this ratio analysis. To me, what this looks like, commodities are cheap and they're starting to outperform stocks. If you look at them in prices of dollars, everything's just going crazy to the upside. Everything. Stocks are going vertical. Commodities are starting to go vertical. Everything's starting to go vertical. So I think you got to hold on to assets, just period. Get your money into assets. I wouldn't be sticking around the dollar. That's me. You guys can do what you want. But I'd rather own a lump of metal than a bunch of paper. Well, is it a bunch of cotton, I guess. It's made out of cotton, right? Something like that. So those are the ratios. Everything looks pretty cheap in the commodity complex. It looks like they're favorably adjusting against everything. I would say platinum's probably the cheapest of everything. Real estate looks cheap in relationship to gold and other assets. Definitely cheap in relationship to stocks. I didn't pull that one up, but it's dirt cheap. So that's what the ratios are saying. If you guys like this type of analysis, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.